It's the early 1930s, and the world is ensnared in the Great Depression. Banks are failing, unemployment is soaring, and despair hangs thick in the air. In the midst of this economic turmoil, a group of the world's most influential bankers and economists convene in Basel, Switzerland. Their mission? To chart a course through the financial maelstrom threatening to engulf the global economy. This gathering isn't just any meeting, it's the inception of the Bank for International Settlements, BIS, an institution that would become the world's oldest international financial organization. But here's the paradox. While the BIS was established to foster international monetary and financial cooperation, its actions during the tumultuous years of World War II have been shrouded in controversy. Accusations arose that the BIS facilitated financial transactions for Nazi Germany, raising profound questions about the true agenda of central banks during times of global crisis. Consider this. Central banks, by design, are institutions meant to stabilize economies, control inflation, and act as lenders of last resort. Yet, throughout history, their roles have often expanded beyond these mandates, sometimes aligning with political agendas or powerful financial interests. This duality, servants of the public good on one hand and instruments of elite power on the other, presents a compelling contradiction. Reflect on the creation of the Federal Reserve in 1913. Born out of clandestine meetings on Jekyll Island, Georgia, where a select group of bankers and policymakers designed a central banking system for the United States. The Federal Reserve's origin has fueled endless debates about transparency and the influence of private interests in public institutions. Fast forward to the 2008 financial crisis. Central banks worldwide, including the Federal Reserve and the European Central Bank, implemented unprecedented measures to stabilize the financial system. While these actions were deemed necessary to prevent economic collapse, they also led to accusations of favoritism towards large financial institutions, leaving ordinary citizens bearing the brunt of austerity measures and economic hardship. This pattern raises an unsettling question. Do central banks operate with hidden agendas, prioritizing the interests of the few over the many? Or are they merely navigating an intricate web of economic and political pressures, making choices that, while controversial, aim to preserve overall stability? As we delve deeper into the annals of financial history, we uncover instances where central banks' actions, whether through intent or circumstance, have had profound societal impacts. From funding wars to influencing political regimes, the reach of these institutions extends far beyond monetary policy. Consider the words of economist Milton Friedman, who criticized the Federal Reserve's policies during the Great Depression, arguing that their restrictive monetary stance exacerbated the economic downturn. He suggested that different actions could have mitigated the severity of the crisis, prompting reflection on the true motivations behind policy decisions. This exploration beckons us to question: are central banks the impartial guardians of economic stability they purport to be, or do they harbor concealed objectives that shape the very fabric of our societies? As we journey through historical events and scrutinize the psychological underpinnings of economic decisions, we aim to unravel the intricate tapestry of central banking and its hidden influences on our world. Beneath the surface of central banks lies a hidden web of historical complexity, driven as much by psychological forces as by economics. The roots of these institutions stretch deep into history, intertwining with human motivations, fear, greed, and power, and societal dynamics that often remain obscured from public scrutiny. To truly grasp the hidden agenda of central banks, we must venture back to their origins and the ideologies that shaped them, guided by minds such as John Maynard Keynes, Adam Smith, Karl Marx, and later Milton Friedman. The creation of central banks often came in response to crises, moments when economies teetered on the brink, and societies, filled with anxiety and uncertainty, sought solace in the promise of financial stability. Take, for instance, the Panic of 1907. In an era without a central banking system, America's financial stability rested on a fragile network of private banks and powerful financiers like J.P. Morgan. When panic swept through Wall Street, Morgan, recognizing the dangerous psychology gripping investors, stepped forward, organizing private bankers to provide liquidity and restore confidence. The intervention worked, but at a significant cost. It exposed just how vulnerable the economy was without a centralized institution. Yet paradoxically, the solution to market panic also laid bare the ease with which power could concentrate in a few influential hands. Out of this revelation arose the Federal Reserve System in 1913, promising independence and transparency, yet born from secret meetings among financial elites on Jekyll Island. John Maynard Keynes understood the psychology at play during economic downturns, famously describing the animal spirits, the irrational behaviors driving market volatility. Keynes argued that fear and greed, far more than rational decision-making, dictated economic outcomes. Yet he too recognized that central banks, despite their seemingly neutral role, could manipulate these very animal spirits by influencing public expectations. By lowering interest rates, central banks stimulate optimism and encourage risk-taking. By raising rates, they foster caution. This control over collective sentiment grants central banks immense psychological leverage, an influence whose limits remain largely unexplored in mainstream economic dialogue. Contrasting Keynes's optimism about state intervention was Karl Marx's profound skepticism. Marx argued that central banks served primarily capitalist interests, operating behind a facade of neutrality to maintain and reinforce class hierarchies. He saw money creation and control as tools wielded by the powerful to ensure systemic stability, not societal equality. Central banks, in Marx's critique, were less about economic stewardship and more about social control. Whether one agrees with Marx or not, his perspective reveals a crucial insight. Institutions entrusted with public financial power inevitably reflect and reinforce existing power structures. Milton Friedman's contributions decades later further complicated this narrative. Friedman viewed central banks, particularly the Federal Reserve, as potential sources of instability rather than pillars of strength. In his groundbreaking work, Friedman argued that misguided monetary policies by the Federal Reserve during the Great Depression worsened the crisis, transforming a severe downturn into a prolonged catastrophe. Rather than acting as neutral custodians of financial stability, central banks, Friedman suggested, often wielded power without adequate accountability or understanding of economic complexities. This critique called into question the narrative of central banks as benevolent stewards, highlighting instead their susceptibility to political pressures and the unintended psychological consequences of their decisions. Throughout the 20th century, central banks increasingly embraced roles extending beyond pure monetary policy. During World War II, the Bank for International Settlements, BIS, initially established for international monetary cooperation, faced accusations of facilitating Nazi Germany's financial transactions. Although defended by some as neutral, economic pragmatism, the BIS's actions raised unsettling questions about how easily central banks could become enmeshed in geopolitical agendas. Such historical episodes underscore the deep, troubling ambiguity at the heart of these powerful institutions. Consider Adam Smith's forgotten warnings. While Smith championed free markets and limited government interference, he also cautioned against the unchecked power of banking interests. Smith recognized the inherent danger in allowing private financial entities undue influence over public economic decisions. Central banks, in theory public institutions, often intertwine deeply with private banking interests, blurring distinctions between the public good and private gain. This conflict remains central to the debate around central bank transparency and accountability even today. The psychological undercurrents that drive economic behavior, confidence, panic, speculation, also shape central bank decisions. Institutions like the Federal Reserve or the European Central Bank must navigate these volatile emotional landscapes carefully, knowing that their actions can ignite optimism or deepen despair. Nassim Nicholas Taleb famously warned against central banks' hubris in presuming they could control economic outcomes through monetary manipulation, emphasizing the hidden risks of their actions. By masking underlying systemic fragility, Central banks may inadvertently create conditions ripe for catastrophic black swan events, unforeseen crises that expose the limits of their influence. Thus, the hidden problem emerges clearly. Central banks, despite their intended neutrality and benevolent mandates, are historically, psychologically, and politically complex entities. Their actions, decisions, and very existence are interwoven with societal power structures, psychological biases, and historical precedents that defy simplistic narratives. They are neither entirely independent nor fully transparent. They exist in a grey zone, often serving conflicting agendas simultaneously. Understanding this complexity is not merely academic. It reveals critical truths about how power, psychology, and finance intersect. But what happens when these hidden truths become drivers of unseen, unintended consequences? How might historical figures have reacted if they had glimpsed these deeper layers of central banking? Moving forward into the 1990s, another ripple effect becomes visible: central bank influence on wealth inequality. As central banks began to rely heavily on lowering interest rates and injecting liquidity into markets, particularly noticeable in the response to the dot-com bubble and later the 2008 financial crisis, asset prices soared, stock markets surged, real estate prices inflated, and those already wealthy saw their net worth explode dramatically. Yet, for ordinary workers and savers, the same era brought wage stagnation, growing debt burdens, and economic insecurity. This was no accident but a predictable consequence, though rarely acknowledged openly. Central bank policies intended to stabilize economies simultaneously widened wealth gaps, fueling deep societal tensions and political backlash. Marx, observing this unfolding scenario, would likely have nodded grimly. His predictions that capitalist economies inevitably concentrate wealth and power in fewer hands seemed prophetic, albeit through the unintended conduit of central banks rather than overt class struggle. The psychological dimension of these unseen consequences is especially profound. Central banks, by stabilizing markets artificially, have conditioned investors and consumers alike to discount genuine economic risk. People come to assume that crises are temporary blips easily corrected by monetary policy. This complacency breeds a dangerous psychological pattern known as moral hazard. When investors believe central banks will always rescue failing markets, they embrace reckless risks, convinced of perpetual safety nets. But Nassim Nicholas Taleb warns clearly against precisely this illusion of control. Taleb would argue passionately that central banks, by fostering this false sense of security, have created economies dangerously fragile to unpredictable shocks. This hidden fragility can be catastrophic. In 2008, when markets unraveled violently, the world glimpsed the frightening truth. Central banks might have inadvertently amplified systemic risk by masking underlying vulnerabilities. Now, imagine a different history, one where central banks were transparent about the limits of their power, openly admitting the uncertainty of their actions. Suppose central banks, instead of constantly attempting to soothe markets, allowed smaller crises to unfold, thereby forcing markets and individuals to confront reality. Could such honesty have cultivated more resilient economies and societies? Thank you for joining me in this journey.